Auditi, Guha is a concern note. I here grant permission to ICAPITAL Academy and Corporate Advisors LLP to use this video presentation PPT as assist and MCQ created and provided by me for educational or professional purpose. This includes publications or sharing to the content on their social media platform, website, or though any other media they deemed appropriate. I confirm that I have no objection to such use. Is my presentation ratio analysis a strategic tool of financial decision making? Financial analysis is the process of evaluating business projects, budgets, and other financial related transactions to determine their performance and suitability. What is financial analysis? Financial analysis allows you to identify the financial strengths and weaknesses of the organization and to make informed decision about its future strategies. It is the essentials for investors, leaders, and the creditors to assess the company's ability to pay back loan or to invest in the company. Here are the types or the fields how financial analysis is done. One is horizontal analysis, second vertical analysis, third ratio analysis, fourth graphical analysis, fifth trend analysis, and sixth is regression analysis. My topic is ratio analysis. Ratio analysis is a quantitative method used to assess a company's financial health by examining its efficiency, liquidity, profitability, and operational performance. This is achieved by analyzing data from its financial statements. It is an important tool of financial analysis. It used to interpret financial statements, show the strength and weakness of the firm, its historical performance, and current financial conditions can be determined. What is ratio? A ratio is a mathematical way to incorporate two or more quantities by showing their relative size. It expresses how many times one quantity is constant other or how they related proportionately. Ratios are often written using a colon or a fraction. It can be expressed as pure ratio, percentage, or a rate. What are the utilities of ratio analysis? It helps to determine how efficiently a firm or an organization is operating. It provides significant information to use of accounting information regarding its performance of the business. It helps in uh, comparisons of two or more firms. It helps in determine both liquidity and long-term solvency of the firm. These are the types of ratio analysis. Ratio analysis are four types. One is liquidity analysis. They measures the firm's ability to meet current obligations. Leverage ratio. This ratio shows the proportion of the debt and equity in financial firms' assets. Activity ratio. They reflects the firm's efficiency in utilizing the assets. Profitability ratio. This ratio measures the overall performance and effectiveness of the firm. First, ratio analysis. Ratio analysis is a class of financial metrics used to assess debtors' ability to pay current debts and obligations without raising external capitals. These are the types of ratio analysis. One is current ratio, second quick ratio, third cash ratio, and fourth is net working capital ratio. Current ratio. Current ratio is a liquidity ratio that measures whether firm has their enough resources to meet its short-term obligations. The current ratio between 1.5 and 2 is generally considered healthy, though it can vary depending on the industry and business models. The formula of current ratio is current asset is equal to current ratio equals to is current asset by current liability. These are the some current assets like cash and cash equivalent, marketable securities, accounts receivables, inventory, repeat liabilities or expenses, other long-term investments. Current liabilities. Some examples of current liabilities that appears in the balance sheet includes accounts payable, payroll dues, payroll taxes, accrued expenses, short-term notes payable, income taxes, interest payable, accrued interest, utilities, rental fees, and other short-term debts. This this is a method how we calculate mm, current ratio in Excel. First, we calculate current assets by adding up the total current asset by adding up the current assets, and then we calculate total current liability by adding up the current liabilities. After that, uh, we apply the current ratio formula. Here in my example, current ratio is 1.03. Quick ratio or acid test ratio. The acid test ratio, also known as quick ratio, is a liquidity ratio that measures how sufficient a company's short-term assets are to cover its current liabilities. In other words, the acid test ratio is a measure of how well a company can satisfy its short-term current financial obligations. A good asset test ratio would typically range between 1 is to 1 to 2 is to 1. This indicates that company has enough liquid assets or such as cash and cash equivalent and marketable securities to cover its short-term liabilities without relying on inventory. Here is the formula of current ratio. Current ratio equals to cash and cash equivalent plus current receivables plus short-term investment by current liabilities. Quick ratio or there is a other formula where quick ratio equals to current asset minus inventory by current liability. Here is a method uh, how we calculate quick ratio in Excel. Cash ratio. Third one is cash ratio. Cash ratio is a liquidity ratio that measures a company's ability to pay off short-term liabilities with highly liquid assets. Compared to the current ratio and quick ratio, it is more conservative measures of company's liquidity position. Cash ratio is considers good if it is between 0.5 and 1. Here is a formula of cash ratio. Formula of cash ratio is cash and cash equivalent by total current liabilities. Cash If cash ratio is greater than 1, then company is financially doing well and can pay its liabilities. If cash ratio is equals to 1, then company has sufficient cash to cover its liabilities. When cash ratio is less than 1, then company doesn't have enough cash to repay its liabilities. Here is a method how we calculate cash ratio in Excel. The net working capital ratio. The net working capital ratio is a financial matrix that measures a company's short-term liquidity by comparing its net working capital to its total assets. It indicates a company's ability to meet its short-term obligation with its available resources. A high ratio generally suggests a better liquidity and financial health, while a lower ratio may signals potential liquidity problems. A good working capital ratio, remember, there is no difference between current ratio and working capital ratio. It considers between 1.5 and 2. Here's a formula of net working capital ratio. Uh, Net working capital ratio equals to current asset minus current liability by total assets. Current assets are the assets that can be converting into cash within a year. Example, cash, account receivable, inventory, etc. Current liabilities are the obligations due to within a year. Example, account payable, short-term loans, etc. Leverage ratio. Types of financial ratio that measures company's level of debt debt relative to the other financial metrics. These are the types of leverage ratio: debt to asset ratio, debt to equity ratio, debt, debt to capital ratio, debt to EBITDA ratio, or asset to equity ratio. First, debt to asset ratio. The debt the debt ratio or the total debt to total asset is calculated by dividing company's total debt by its total asset. It is also called debt to asset ratio. It is a leverage ratio that defines how much debt a company carries compared to the value of the asset it's owned. For companies with low debt to asset ratio such as 0% to 30% is mainly advan- advantage is that the main advantage is that they would ensure less interest expenses and also have greater static flexibility strategic flexibility. For example, a company might determine what what casing to the offer particular product or services would be their base long-term interest. The formula of debt to asset ratio is total funded debt by total asset. Here is a way how we can solve debt to asset ratio in Excel. First, first we First, we write the total asset, then total debt, then applying the total debt to asset ratio. Here, debt to asset ratio is 5%. Debt to equity ratio. Debt to equity ratio or DE ratio describes how much debt a company has corporate to its asset. It is calculated by dividing a company's total debt by total shareholders' equity. Note, a higher debt ratio states the company may have more difficult time difficult time to con- converting uh, converting converting its liability. Generally, a good debt ratio for a business is around 1 to 1.5. However, debt to equity ratio can be significantly based on the business growth stage or industry sectors. For example, newer or extending companies offer utilizing debt to drive growth. DE ratio formula. DE ratio equals to or debt to equity ratio equals to short term debt plus long term debt plus other fixed payments by shareholders' equity. Here the way how we calculate debt to equity ratio in Excel. Debt to capital ratio. The debt to capital ratio is a financial matrix that measures companies' financial leverage by dividing its total interest bearing debts by the sum of its total debt and shareholders' equity. A good debt to capital ratio typically falls between 0.3 and 0.6, indicating a balanced use of debt and equity to the finance and company's obligations. A lower ratio suggests a reliance less reliance on debt, while the higher ratio indicates a greater risk. Debt to capital ratio formula is debt to capital ratio equals to total debt by total debt plus total equity. Here the way how we calculate debt to capital ratio in Excel. Debt to EBITDA ratio. Debt to EBITDA ratio measures company's ability to pay off its debt. A high ratio may indicate that company debt is uh, too heavy a financial burden. If our business were to borrow from a bank, the bank might include a debt to EBITDA ratio in our loan agreement. The interpretation of debt to EBITDA ratio can vary by industry, but some general guideline applies. A ratio below 2 indicates lower financial risk and strong debt servicing capacity. A ratio between 2 and 4 is considered moderate, but causing cautions might be warranted, depends on the industry. Debt to EBITDA ratio. Debt to EBITDA ratio equals to debt by EBITDA. How we calculate EBITDA? EBITDA formula is net income plus interest plus tax plus depreciation and amortization. Here Here is show how we calculate debt to EBITDA ratio in Excel. Assets to equity ratio. The assets to equity ratio is a ratio of total asset dividing by shareholders' equity. The assets by equity ratio indicates the relationship of the total assets of the firm to the part owned by the shareholders or owner's equity. The ratio depends on the company's industry assets and financial conditions. There is no ideal ratio values, but every company like to keep it below the value of 2. The equity ratio formula: total equity by total assets. Here we can calculate equity in two ways. First one is equity equals to total asset minus total liability, or total asset minus current liability. Uh, or second one is capital stock plus shareholders premium preference plus preferred stock plus return earnings plus accumulated other comprehensive incomes minus treasury stocks. The formula of total asset is non-current asset plus current asset. Here the show how we calculate equity ratio in Excel. Activity ratio. Activity ratio is a indicators of how efficiently a company use its assets to generate revenue and cash. Here the types of activity ratios: stock turnover ratio or inventory turnover ratio, debtors turnover ratio or accounts receivable turnover ratio, creditors turnover ratio or accounts payable turnover ratio, working capital turnover ratio, and investment turnover ratio. First, stock turnover ratio. This is one of the most important turnover ratio which highlights the relationship between the inventory or the stock in the business and the uh, good cost of the goods sold. It shows how fast inventory gets cleared in an accounting accounting period, or its other words, the the number of times the inventory or the stock gets sold or consumed. For this reason, it is also known as inventory turnover ratio. Sorry. A stock turnover ratio is a financial metric that measures how often a company's inventory is sold or replaced over a specific period. Two different approaches to calculating the stock turnover ratio exist, such focusing on different aspects of inventory management. Stock turnover ratios formula. Stock turnover ratio formula equals to cost of goods sold by average inventory. A high stock turnover ratio indicates of the high moving goods in the company, while low stock turnover ratio indicates that goods are not getting sold and are being stored in the warehouse for an extended period of time. Cost of goods sold. This represents the aspect of cost associated with producing or purchasing the goods that we have sold during the period. Cost of goods sold equals to beginning inventory plus purchase minus ending inventory. Average inventory. Average inventory. This is typically the calculation of adding the beginning and end inventory for the period and divided by 2. Inventory Average inventory formula is beginning inventory plus ending inventory by 2. This is a way how we calculate stock turnover ratio in Excel. First, we calculate average inventory. First, we calculate average inventory and cost of goods sold. Then, applying the inventory turnover ratio formula. Here, inventory turnover ratio is 10.44%. Debtors turnover ratio or account receivable turnover ratio. This ratio is important indicators of a company which shows how well a company is able to provide credit facility to its customers, and at the same time is also able to recover the due amount within a payment period. This is also known as account receivable turnover ratio, as the payments of the credit sales that will be received in the future are known as account receivables. Formula. Account receivable turnover ratio formula is net credit sale by average account receivable. A higher ratio indicates that the credit policy of the company is sound, while a lower ratio shows a weak credit policy. Net credit sales equals to total revenue earned by selling products and services on credit. Net credit sale equals to gross credit sale minus sales return. We can also say net credit sales equal to gross credit sales minus sales return minus, we can also less the allowances. Average account receivable. The average account is yet to be received from the customer. Average account receivable equals to opening balance plus closing balance by 2. Here's here show how we calculate average account receivables. And after applying account receivable turnover ratio, we can receive account receivable turnover ratio 14.48%. Creditors turnover ratio or account payable turnover ratio. Creditors turnover ratio is a measures of a capability of a company to pay off its account for credit purchase successfully in an accounting period. It shows the number of times the account payable are cleared by the company in an accounting period. For this reason, it is also known as the account payable turnover ratio. Account payable turnover ratio or formula is credit purchase by average account payable. A high ratio indicates that the company is able to finance all the credit purchases or vice versa. Total purchase equals to till closing inventory plus cost of goods sold minus opening inventory. And average account payable formula is opening account payable plus closing account payable by 2. Here is the way how we calculate account payable turnover ratio. Working capital turnover ratio. The working capital turnover ratio measures how efficiently a company uses its working capital to generate sales. It's calculated by dividing net sales by average working capital. A higher ratio generally indicates better efficiency in utilizing working capital for sales generation, while a lower ratio might suggest in inefficiencies or potential issues that inventory or credit management. Working capital turnover ratio formula is turnover on net sales by working capital. Net sales equals to total total sales to total sales revenue after deducting sales return, discounts and allowances. Average working cap Average working capital is beginning working capital plus ending working capital by 2, where the working capital is calculated as current asset minus current liability. Turnover ratio. Turnover ratio is 11,50,000 and current as and working capital is 4 lakhs. So the working capital turnover ratio is 2.88%. Investment turnover ratio or net asset turnover ratio. Net asset turnover ratio is a measurement of the ability of management to use the firm's net assets to generate sales revenue. Calculate as sales revenue divided by the capital employed. Too high, too high a number may indicates too little investment, while too low OR ratio relative to the comparable firms suggests inefficient management. At asset turnover ratio. Asset turnover ratio is net sales by average total assets. Here net sales are the company's total revenue from selling goods and services. Average total assets are the total value of company's assets including current and fixed assets. Here the way we can calculate asset turnover ratio in Excel. Profitability ratio is a class of financial metrics that used to assess a business ability to generate earnings related to its revenue, operating cost, balance sheet assets, or shareholders equity over time using data from the specific point of time. Here are the types of profitability ratios: gross profit ratio, operating profit ratio, net profit ratio, return on investment or ROI, return on net worth, earning per share, book value per share, dividend payout ratio, and price earning ratio. Gross profit ratio. Gross profit ratio is a profitability ratio that measures the relationship between the gross profit and the net sales revenue. When it is expressed as percentage, it also known as gross profit margin. A fluctuating gross profit ratio indicates of inferior product or management management practices. Here, here are the basic level of gross profit margin. Features considers low, average, or good. Generally, gross profit margin is of between 50 to 70% is good, and anything above that is very good. Gross profit ratio equals to gross profit by net sales into 100. Gross profit equals to revenue minus cost of goods sold. And net sales equals to gross sales minus return minus return allowances and discount. Here the way how we calculate um, cost profit ratio in Excel. First we calculate cost of goods sold. Then we then we applying gross profit. The gross profit ratios formula. Here cost profit percentage or gross profit margin will be 24.9%. Operating ratio is calculated to determine the cost of operating in rela- in relation to the revenue earned from the operation. The operating ratio is financially mat- exponentially metric that indicates how efficiently a company is managing its operating cost relative relative to its revenue. An optimal operating expenses ratio is typically between 60 to 80%, with lower percentage indicates greater efficiency. Sorry. Operating ratios formula. Operating expenses by net sales into 100. Operating expenses are the costs not directly tied to production but necessary for running the business, like example rent, salary, marketing. Net sales is equal to total revenue after deducting return and allowances. Operating expenses. Here operating expenses is 3,000. Cost of goods sold is 1,000 and net sales is 5,000. So operating ratio is 80%. Operating profit ratio. Operating profit ratio is a typically profitability ratio that is used for determining operating profits and net revenue generated from the operation. Is expressed as a percentage. Generally, 10% operating profit margin is considered considered average performance, and a 20% margin is excellent. It's also important to pay attention of the level of interest payments from a company's debt. Operating margin formula. Operating profit by net sales into 100. Operating profit is net sales minus cost of goods sold plus administrative and office expenses plus selling and distribution expenses. Here's the way how we calculate operating profit ratio. Net profit ratio. Net profit ratio is an important profitability ratio. Shows the relationship between the net sales in the profit after tax. Show the relationship between net sales and the net profit after tax. expressed as a percentage is also known as net profit margin. It helps investors in determining whether the company's management is able to generate profit from the sale and how well a company's com- how well the operating costs and the costs related overheads are contained. 10% is considered a healthy margin. This indicates that a company is managing its costs effic- um, effectively and generating a decent profit. 20% is considered a high margin. Companies with a high margin typically has a unique product or services, strong brand recognitions, or the operate industries with least competitions. Here the formula of profit ratio. Net profit by revenue into 100. Net profit equals to total revenue minus cost of goods sold plus operating expenses plus other expenses. Here the way how we calculate um, net profit margin. Return on capital employed or return on investment. Return on capital employed or return on investment is a profitability ratio that measures how well a company is able to generate profits from its capital. It is an important ratio that is mostly used by investors while screening uh, for companies to invest. ROCE or return on capital employed examines how efficiently a company uses available capital within following equation. ROCE equals to EBIT by capital employed. EBIT equals to earning before interest and tax, and capital employed equals to total asset minus current liabilities. Here the way how we calculate return on capital employed. Next set. ROI or return on investment this is popular profit matrix used for evaluate companies investment and their financial consequences with respect to cash flow. The formula of ROI results in a percentage and and is is calculated as follows. ROI equals to net profit by total investment into 100. Here is a way how we calculate ROI in Excel. Return on net worth. This is also known as return on shareholders fund and is also and it used for determining whether the investment done by the shareholders are able to generate profitable returns or not. It shows it should always be higher than the return on investment, which otherwise would indicate that the company funds are not utilized properly. Return on net assets or return on net worth. Income by fixed asset plus net working capital. Return on net assets or RONA. Here RONA is 25%. Here is show how we calculate return on net asset in Excel. Earning per share or EPS. Earning per share is the monetary value of earning per outstanding shares of a common stock for a company during a def- defined period of time offered a year. It is a key measurement of corporate profitability, focusing on the interest of the company's owner or shareholders, and it's commonly used for price the stock. There is no definition of good or bad EPS value, all other all other things being equal, the higher a company's EPS is better. Uh, the the opposite is true for the company's price to earning ratio. Earning per share or EPS equals to total income minus preference dividend by weighted average number of shares of outstanding. Here we calculate EPS in Excel. Book value per share. Book value per share is the uh, book value per share is referred to as the equity that available to the common shareholders divided by the number of outstanding shares. Book value per share is the book value of total equity of the company divided by total number of outstanding shares. Learn how we calculate BVPS and use to assess whether the stock is undervalued or overvalued. This will help you in making more informed investment decisions. Uh, what is good? What is good price to book value ratio? The value investors offer to prefer the value is lower than 1, suggest that an undervalued stock might have been found. The benchmark of a certain value investors, however, may frequent sorry frequently be equities with less strict PB value is less than 3. Book value per share less equity minus asset to liability. Common shareholders equity equals to shareholders equity minus preferred share. Here we calculate shareholders equity, and after that we are calculating book value per share in Excel. Here book value per share is 25. Dividend payout ratio. Dividend payout ratio calculates the amount paid to the shareholders and dividing is relation to the amount of net income generating by the business. A dividend payout ratio is the dividend payout ratio is protein potentially earnings paid to the shareholders by dividends. Some companies pay out all their earnings to the shareholder. Some only pay out the portion of their earnings, while other doesn't pay any dividends to the shareholders at all. Generally, generally speaking, dividend payout the ratio of 30 to 50% is considered healthy, while anything above 50% could be unsustainable. Dividend payout ratio formula: total total dividends by net income into 100, or this is the other formula, which is dividend payout ratio equals to dividend per share by earning per share. Here we are calculating the dividend payout ratio of Indian Oil Corporate Limited. Price earning ratio. This is also known as PE ratio. Is establish a relationship between stock share stock stock price of the company and the earning per share. It is very helpful for the investor, as they will be more interested in doing the profitability of the shares of a company and how much profitable it will be in future. Price to earning, or PE ratio, is a proportions of a company's share to its earning per share, or EPS. A high PE ratio could mean that company stock is overvalued, or the investors expect high growth rates. Price to price to earnings ratio. Market price of share by earning per share. A good P ratio isn't always high or low. Low ratio, low ratio on its own. The market average P ratio is currently between 20, 20 and 25. Therefore, the higher PE ratio above may be deemed negative, while the lower PE ratio may be considered better. Market value per share. It is calculated by considering the market value of the companies divided by the total number of outstanding shares. Earning per share by EPS is calculated by sustaining preference dividend for the company's net income and dividing the results by the total number of common shares. Market price as of 14 December 2018 is $165.48, and the annual EPS of for the financial year is 11.91. So P ratio is 13.89. The uses of financial ratio. There are two types. There are two types of users. One is external user. External users are financial analysts, retail investors, creditors, competitors, tax authorities, regulatory authority, and industry observers. And internal users are management team, employees, and owners. Different terms that use for compounding financial ratio. This is a format of profit and loss statement for a year, and this is a format of balance sheets for year. This is also a form. This is also a format of balance sheet. Limitation of ratio analysis. There are six limitations of ratio analysis. One is historical information. Two, inflation effect. Three, changes in accounting policy. Four, operational charges. Five, seasonal effect. And six, munis municipalizations of financial statements. Historical information used in a analysis based on real past results that's are released by the company. Therefore, the ratio analysis matrix do not necessarily represent the future company performance. Inflation effect. Financial statements are released periodically. Financial statements are released periodically, and therefore there is a time difference between each release. If inflation occurs between this period, then real prices are not reflected in the financial statement. Thus, the number across the different periods are not comparable while they are adjusting adjusting for inflation. Changes of accounting policies. The company has changed its accounting policy and procedures. It may significant effect in financial reporting. In this case, the key financial metrics utilize the ratio analysis are altered, and the financial results recording after charges and not comparable to the financial results recording after charges and not comparable to the results recording after the charges. It is up to the analyst, and if up to the analyst to be up to date with changes of accounting policy. Changes made are generally found the note in the financial statement section. Operational changes. A company may significant changes in the operational structure. Anything from the supply chain strategy to the product that they are selling. When a significant operational changes occurs, the company of the financial metrics before and after operational changes may lead to misleading cons- consequences about the company's performance and financial pro- prospects. Seasonal effect. Our analysts should be aware of financial factors that should potentially result in limitations of ratio analysis. Its uh, the inability of adjust the ratio analysis to the seasonal effect may lead to the false interpretation of the results from the operations. Munis, munis, money, money, manipulations of financial statements. Ratio analysis is based on information that are reports by the company in a financial statements. This information may be manipulated by companies' management as the report or the better result than its actually performance. Hence, the ratio analysis may not accurate reflect the true nature of the business as a misrepresentation of information is not detected for a simple analysis. It is important that an analyst is aware of these position manipulations and always always completes existence due diligence before reaching any conclusions. Applications of ratio analysis. Using ratio analysis while giving off multiple figures and the value to compare. However, those values will be very little isolated. Isolated instead Instead, the values derived from this ratio should be compared to the other data to determine whether the company's financial health is strong, weak, improving, or deteriorating. Advantages of ratio analysis are as follows. It helps to forecast and planning by performing trend analysis. Helps in it helps in estimates budgets for the firm by analyzing previous trends. It helps in determining how efficient a firm or a organization is operating. It provides significant information to users of the accounting information regarding the performance of the business. It helps in comparison of two or more firms. It also determines both liquidity and long-term solvency of the firm. These advantages of ratio analysis. Financial statements to be complicated. Several organized organization work in various enterprises such as processing different environmental positions such as market structure, regulation, etc. Such factors are important that a comparison of two organizations from the various industry might be ambitious. Financial accounting data is influenced by viewing and hypothesis accounting criteria providing different accounting methods which reduce comparability, and thus ratio analysis is less helpful in such criticism. Ratio analysis illustrates the association between prior data while using are more concerned about current and future data. About company. ITC Limited is a diversified con- conglomerate that the significant preference in India. Established in 1910, organization known as the Im, Im, Imperial Tobacco Company in India. It also evaluates into the major players according to the various sectors, including FMCG, hotels, paper boards, and special papers, packaging, agricultural business, and information techniques. It is known as the strong brand building capacity, distribution reach, and the component to sustainability. Key business areas are FMCG. ITC FMCG's portfolio include popular brands like Ashirvad, Sunpeace, Bingo, and more. Hotels. ITC owns and operates a chain of luxurious hotels, paper boats, and special papers. ITC is a leading manufacturer in this segment. Packaging. ITC is involved in the various packaging solutions. Agriculture and business. ITC's agricultural business focus on empowering farmers and managing agricultural value chains. Informational technology. ITC Infotech provides IT services to the various industries. Key aspects. Diversification. ITC is a successful diversify its business beyond its origins of tobacco. Sustainability. ITC is recognized for its commitment for sustainability, including being carbon, water, and soil waste recycling positive account according to the link. Social aspect. ITC's business and the value chain creates livelihood for the millions of the people. Privately is a rural India. Strong brand portfolio. ITC has built a strong portfolio and the brand across the various categories. Market leader. ITC hotel leadership positions in several sectors, including FMCG, paperboard, and agricultural businesses. ITC product categories. There are many product categories. Packaging foods like Ashirvad, Sunpeace, Bingo, etc. Personal care, Piyama, Bibble, um, Savlon, etc. There is some educational, the well-known band classmate, paper craft, etc. And matches or agarbatti, home lights, Mangaldeep, etc. Hotels. ITC owned and operate a vast network of hotels across India under various brands including ITC Hotel Luxury, Mementories, Welfare Hotels, etc. Paperboard and paperboard and paper packaging. This segment produces especially paper and packaging material, including flexibilities. Agricultural business. ITC deals in an agricultural commodities like wheat, rice, spices, coffee, soya, and leaf tobacco. Others ITC MasterChef like frozen food, farmland, frozen vegetables, sunrise, spices. These are the some examples of ITC products. There's a what is standalone and consolidated. Standalone and consolidated refers the different way of reporting company's financial performance. Standalone statements focus on the single entity, while consolidated statements consolidated statements combine the financial data of a parent company and its subsidiaries. Essentially, standalone statement represent the financial health of an individual company, whereas consolidated statements offers a broader view of corporate groups' overall financial positions. Standalone financial statements. Scope. Focus on financial performance, positions, and cash flow of the single company without considering subsidiaries. Purpose. Purpose is providing a view of company's financial health as an independent entity. Example, a company's balance sheet, income statement, and cash flow statements that only include its own assets, liabilities, revenues, and expenses. When useful, useful for analyzing performance for a specific company. Essentially, when it operates independently or when comparing company within the same industry. Consolidated financial statement. The combined financial data of a parent company and all subsidiary into the single set of financial statement. Purpose: providing a comprehensive view of financial health of a entire corporate group. Example, a parent company's balance sheet that includes all assets, liabilities, and equity and all subsidiaries for all subsidiaries. When used essentially for understanding the overall financial performance and the positions of the company with subsidiaries, essentially when making investment decision, assessing the overall risk. The key difference between them is scope of analysis. Standalone statements offer a limited perspective, while consolidated statements provide more comprehensive view of including subsidiaries. Financial data. Standalone statements only include the data of the parent company, while consolidated statements combines the data of the parent and its subsidiaries. Inventory inventory pers- perceptives. Investor perceptive. Investors are considerate the statement assess the overall financial health of the performance and the corporate groups, while standalone statements are used for analyzing the parent company's performance and associates. According to the budget booking, PE ratio. The P the price to earning ratio or P ratio is calculated differently. Standalone statement use the parent company's earning, while consolidated statement use the combined earnings of the parent and subsidiaries. This this is ITC Limited 5-year standalone profit and loss account. This is ITC Limited standalone profit and loss account. This shows ITC Limited 5-year standalone balance sheets. ITC Limited's last 5-year standalone financial ratios are: basic EPS for 25 is 28.15, 24 is 16.39, 23 is 15.15, and 22 is 12.22. 21 is 10.10.52, point something. Diluted EPS. Diluted EPS is 28.11 for 2025, 16.35 for 2024, 15.11 for 2023, and 12.22 for 2022, and 10.59 for 2021. Cash EPS. Cash EPS is 29.28 for 2025, 17.68 for 2024, 16.43 for 2023, and 13.56 for 2022, and 11.86 for 2021. Book value Excel reversal revenue per share is 24.26 for 2025, 27.86 for 2024, 54.39 for 2023, 49.82 for 2022, and 47.94 for 2021. Dividend per share is 14.39, 13.75, 15.50, 11.50, and 10.75. These are some per share ratio. These are some per share ratio. Revenue from operations are 55.40 for 2025, 52.40 for 2024, 33.14 for 2023, 45.75 for 2022, and 36.95 for 2021. PBDIT per share or EBDIT per share is 21.96%, 22.44, 21.33, and 17.47, 15.24. PBIT per share is 20.81%, 21.12%, 19.86%, 16.13%, and 13.93%. PBT per share is 21.20, 21.08, 19.92, and 16.09, 13.94. Net profit share is 28.12 in 2025, 16.36 in 2024, 15.09 is in 2023, 12.22 in 2022, and 10.59 for 2021. These are the profitability ratio of ITC Limited, and for past 5 years. PBI, PBDIT margin is 39.63, 42.81, 56.96, and 38.20, and 41.27. PBIT margin 37.50, 40.29, 37.42, and 35.26, and 37.87. Net profit margin is T.77, 31.20, 28.90, and 26.27, and 28.65. Return on net worth or by equity was to 51.83, 28.27, 27.74, 24.52, and 22.08. These are the profitability ratios. Return on capital employed and capital employed are 26.73, 36.73, 35.20, 35.90, and 31.23, and 28.03. Return on assets. Return on assets are the 41.89, 23.0, 23.38, and 22.97, and 20.05, and 18.02. Total debt to equity ratio is 0 for last 5 years. Asset turnover ratio. Asset turnover ratio is 0.81, 0.77, 0.84, 0.77, and 0.62. These are the liquidity ratios of ITC Limited. Current ratios are 3.03, 2.91, 2.84, 2.07, and 3.13. Quick ratios are 1.88, 1.86, 1.93, 1.82, and 2.20. Inventory turnover ratio. Inventory turnover ratio is 1.67, 1.84, 1.92, 1.65, and 1.55. Dividend payout ratios are 23.10, 38.19, 39.71, and 42.96, and 47.21. Dividend payout ratios are 22.19, 35.13, 36.39, and 38.71, and 42.16. Earning retention ratios are 26.90, 61.81, 60.29, and 57.47, 52.79. Cash earning retention ratio 77.81, 64.67, 63.52, 61.29, and 57.86. These are the valuable ratio. Enterprise values are here. EV by net operating EV by net operating ratio is 7.35, 8.05, 7.16, 8.42, and 5.86. EV by EBITDA is 18.55, 18.87, 17.92, and 14.18, 14.18, and 14.11. Market cap by net operating revenue is 7.40, 8.18, 7.22, 5.86, and 5.81. Retention ratio is 76.86, 61.80, 60.29, 57.03, 52.78. Price to book value ratio is 7.55, 7.41, 7.05, 5.03, and 4.56. Price to net operating revenue 7.40, 8.18, 7.22, 5.49, and 5.81. Earning yield 0.07, 0.04, 0.04, 0.05, and 0.05. These are the ITC Limited last 5 years consolidated profit and loss accounts. IT. These are ITC Limited's 5 years consolidated balance sheet. This is par capital ratios. Basic EPS are 27.79, 16.42, 15.50, and 12.37, and 10.70. And the diluted EPS is 27.75, 16.38, 15.46, and 12.37, and 10.70. Cash EPS is 29.24, 18.04, 17.09, and 13.97, and 12.2. Book value is 15.96, 55.96, 59.99, 55.95, 3.93, and 49.31. Book value in sale reversal revenue per share is same as book value to Excel reversal revenue per share value. Revenue from the operation per share 60.19, 56.77, 57.09, 59.29, or 40.03. Per capital ratio PB PBDIT per share is 22.7, 23.21, 22.24, 18.25, and 15.95. PBIT per share is 21.47, 21.76, and 20.76. 16.85 and 14.62. PBT per share is 21.43, 21.72, 20.83, and 16.82, and 14.58. Net profit per share 27.93, 16.20, 15.60, 12.62 and 12.56. 10.80. Net profit after MI and SWAT per share. 27.77, 16.39, 15.44, 12.37, and 10.69. Profitability ratios. PBIT margins 37.87, 40.88, 38.97, 37.07, 39.85. PBIT margin is 35.66, 38.32, 36.42, 34.52, and 36.51. PBT margin is 35.60, 38.25, 36.46, 34.15, and 36.41. Net profit margins are 46.38, 39.23, 27.38, 24.52, and 27.17. Net profit after PI and SOS margin is 46.12, 38.86, 37.05, 35.12, and 36.71. These are the profitability ratios. Return on net worth per equity is 49.61, 27.45, 27.75, 24.40 or 21.80. Return on capital employed is 26.41, 24.75, 25.81, 31.86, and 28.59. Return on assets are 39.44, 22.27, 22.38, and 19.47, and 17.8. Total debt by equity is 0 for last 5 years. Asset turnover ratio is 0.84, 0.80, 0.83, 0.76, and 66.76. Liquidity ratios. Current ratio is 3.06, 3, 2.89, 2.81, and 3.27. Weak ratios are 1.86, 1.95, 2.02, 1.93, and 2.29. Inventory turnover ratio. Inventory turnover ratio is 1.58, 1.66, 1.84, 1.57, and 4.63. Dividend payout ratio are 23.40, 41, 38.81, 42.44, 46.74. Dividend payout ratios are 22.34, 37.66, 35.46, and 38.11, and 41.55. Earning retention ratios are 76.6, 59, 61.19, 57.56, and 53.26. Thus, earning retention ratio is 77.66, 62.34, and 64.54, 61.89, and 59.45. So the coverage ratio, interest coverage ratio is 630, 632.67, 630.62, 639.94, 61.51, and 404.54. Interest coverage ratio is 632.67, 630.660, 639.94, 671.51, and 403.50. Here, interest coverage ratio and interest coverage ratio post tax are same. Valuation ratio. Enterprises values are here. EV by net operating revenue is 6.67, 7.45, 6.66, 5.02, and 5.37. EV by EBITDA is 17.86, 18.32, 17.08, and 13.55, and 13.48. Market cap on net operating revenue is 6.81, 7.55, 6.72, 5.09, 5.46. Retention ratio is 46.59, 48.99, 61.18, 57.55, and 3.25. The valuation is price to book value ratio is 7.32, 7.18, 6.89, and 4.95, 4.46. Price to net operating ratios are 6.81, 7.55, 6.72, 5.09, 5.46. Earning yields is 0.07, 0.04, 0.04, 0.05, and 0.05. Earning yield for standalone and consolidated ratios are same.